Investing for cash flow from dividends is getting harder. Companies have been cutting their dividends to redirect that cash into staying afloat. Even dividend champions have been wielding the axe, but high yields are still out there.
We invest in ETFs for instant diversification and access to entire markets without the stress of managing hundreds of stocks. But amazingly, specific ETFs can be used if your goal is to maximise income from your portfolio. For dividend investing, using ETFs bring the added advantage that if some companies in the index cut their distributions, others may not, so we are far less likely to go without.
All of the ETFs in this video are of course distributing funds, meaning they pay out the dividends rather than reinvesting them. Just what we want from a dividend ETF. We're particularly psyched about the cash pumping prospects of 5 dividend ETFs right now, and that's what we're talking about in this video. Let's check it out.
Welcome to MoneyInShackle.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button, click subscribe. Number 1. SPDR S&P UK Dividend Aristocrats ETF. Let's kick it off with one of the best UK market dividend ETFs from the SPDR Aristocrat family of ETFs. This fund has an ongoing charges figure of 0.3% and transaction costs of 0.3%, which totals a 0.6% total product cost. The dividend yield currently comes in at 4.82%.
The UK stock market is one of the best in the world for dividends, and this ETF aims to exploit this for income investors. It follows a Standard & Poor's index that includes 36 companies. On the face of it, that's not that many companies. We usually like our ETFs to contain hundreds of stocks, but this fund has a good excuse for not doing so.
This ETF has a rule built in that companies must either increase or maintain their dividends for at least 7 years. It goes so far as to eject any company who has not been able to maintain their dividend payouts. Think about that. All 36 companies in this fund had to clear an extremely tall hurdle in order to make the cut. In this case, less is more. That's more income in your pocket.
What it means for you is that the yield of 4.82% is very well protected from cuts. Let's say, for example, if 10 companies cut their dividend this year due to the recession, these 10 stocks will be sold out of the fund and your capital will be spread over the remaining 26 companies, plus any new ones have recently cleared the entry criteria. In this way, your yield is well protected from market volatility.
Number 2. iShares UK Dividend ETF. Staying with the UK market for now, it does pay sweet dividends. Next we're going to look at iShares' famous high dividend fund. And it is high. The dividend yield currently comes in at a whopping 6.02%. This fund has an ongoing charges figure of 0.4% and transaction costs of 0.31%, which totals a 0.71% total product cost. The fund seeks to track the performance of the highest yielding 50 stocks from the FTSE 350 index of UK listed companies.
A quick note on OCF and yield. The ongoing charges figure, or OCF, is an annual management fee that ETF providers charge. The OCF, although widely published, does not consist of all the fund's charges. The internal trading costs are in addition to the OCF and known as the transaction costs. An OCF of 0.3% is usually about as much as we're willing to pay, max 0.4% with dividend ETFs. Because dividend ETFs tend to cost a little more than generic market trackers as they are a slightly more specialised product.
If the ongoing charges figure is much higher than that, we'd seriously consider not investing unless the offering was unique and too good to ignore. That's because even seemingly small fees eat away at your portfolio's value over time.
On yield, when a stock or ETF tells you its yield, it's described in the past. The yield is based on dividend distributions already made. We want to know if an ETF will pay dividends in the future. While past performance data isn't great for predicting share price movements, it is actually quite reliable for predicting dividends. The trend has always been that companies who consistently paid dividends in the past will continue to do so in the future. Of course, don't entirely rely on this.
And we can look at the ETF strategy. Going back to the iShares UK Dividend Fund, its strategy is forward-looking. It tracks the top 50 UK stocks based on their forecast one-year dividend yield. This will consider past performance but also current market conditions, a key distinction from most other dividend ETFs who base their strategy on the past.
Number 3, Vanguard FTSE All World High Dividend Yield ETF. Now we're going global. This is a Vanguard fund, so you know it's going to be cheap, with an OCF at 0.29% and transaction costs of 0.04%, which totals just 0.33% total product cost. It has a dividend yield of 4%, lower than the others we've covered. But it has holdings of 1,634 stocks from all around the world, so it is massively more diversified than the UK funds.
The constituent stocks are selected from a FTSE All-World Index, excluding REITs, and then are ranked by forecast dividend yield. The ones expected to pay no dividends at all are cast aside. Then of those stocks remaining, the best performing half are selected for the fund.
To summarise what you're getting here, you're basically starting with a Vanguard all-world tracker and filtering out every stock which pays a crappy dividend.
Number 4, SPDR S&P Global Dividend Aristocrats ETF. Staying global, this SPDR Aristocrat ETF is very similar in methodology to the ETF we mentioned first, this time having to prove that they have maintained or increased dividends for 10 consecutive years, plus a healthy record of cash flow in their accounts.
The OCF is high at 0.45%, but the transaction costs are acceptable at 0.13%, giving us a total product cost of 0.58%. But we're thinking the protection provided by their strict entry requirements justifies the higher than average OCF, and it has a high dividend yield of 5.27%. We consider a yield to be excellent if it's 5% or more, while 4% is a good yield. The S&P 500, America's main stock index, for comparison, only has a yield of 2%.
What about those 8% market returns that we're always banging on about? Well, dividend ETFs will probably return lower than that because there is less growth. High dividend paying stocks tend to be those that are well past their growth stage. We expect to see some moderate stock price growth as well from these funds over the long term, in addition to those juicy dividend payouts. Maybe a fund yielding 5% dividends will also grow by 2% over the long term, totaling maybe 7%.
This Global Aristocrat ETF contains just 88 stocks. That's right, only 88 stocks in the whole world make the cut. How's that for a specialist dividend fund? Off the lot, this is probably our favourite dividend ETF.
Dividend traps. Dividend traps, or yields that are too good to be true, are not uncommon among dividend stocks. Sometimes a high yield, which is backward looking, is as a result of a drop in the share price caused by business trouble, and dividend cuts or suspensions may follow. Remember, if the share price falls but the dividend payout remains the same, you're going to end up with a higher yield relative to the new share price, which artificially looks better than it is.
Screen for traps. Number 5, WisdomTree Global Quality Dividend Growth ETF. Strategies that screen companies for quality can improve the chances of avoiding such traps. It starts from a position of picking the best companies for capital growth and quality and then weighting them by dividend.
The fund tracks only the companies with the best combined rank of growth and quality factors from global developed markets, selected from the WisdomTree Global Dividend Index. Companies making the cut have a high quality score based on business fundamentals such as debt to equity ratio, return on assets, and earnings.
This step is very important, as typically these would be the firms with the strongest growth signals and least prone to cutting dividends in the future. These are then weighted in order of cash dividends each company paid over the previous year.
In this, we're getting a fund which is very likely to grow in price but also pay us a decent dividend yield. By contrast, the previous ETFs we've considered do not screen for quality of business fundamentals. They simply tilt their portfolio towards the stocks with the highest expected dividend yield.
The OCF is 0.38% and transaction costs come in at just 0.02%, giving us a total product cost of 0.40%. The dividend yield is lower than the others at 2.54% because you're getting a better balance of growth and dividends here. Look at the companies we're getting in the top 10 holdings, not stereotypical dividend payers, but companies that are around for the long term and can also be relied on for cash flow. There are only 528 stocks in the index, despite being global. It's less picky than the aristocrat funds, but it's still cutting out huge swathes of world companies who couldn't pass through the growth quality filter.
Bonus number 6. Not a dividend ETF, and yet it pays a really good dividend yield regardless. The iShares Core FTSE 100 ETF. We feel obliged to mention it because it's just so damn cheap.
It has a total product cost of just 0.02%, tiny, and the dividend yield is a mighty 5.43%. Buyer beware. This ETF currently pays a great dividend. However, this is coincidental as it's not specifically designed to do this, unlike the 5 dividend ETFs covered in this episode.
How to invest. ETFs 1, 2, 3 and 6 can be bought on a number of good zero-fee commission apps such as Freetrade. Sign up using our link on moneyunshackle.com, linked to below, and you'll be given a free share worth up to £200 as a welcome bonus.
If you want to screen for dividend traps and buy all 6 of these ETFs, then you're going to need a premium broker platform. For example, Interactive Investor can be used to buy a wider range of investments that just isn't available on the free apps. We put a link to Interactive Investor in the description below. Thanks for watching. On this channel we talk about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.